So I have to admit, given everything that's been going on in the markets in the last 3 weeks, I really wasn't expecting stocks to start shooting back up as much as they have already. What I thought would be a longer period of price declines or at least flatlining share prices in the markets haven't actually panned out the way I was hoping, at least for the time being. The S&P 500 just had 3 consecutive weeks of positive returns, and right now it's still down over 13%. But just 3 weeks ago though, it was down over 23%, so it has been making a strong comeback as of recently. And from what we've been seeing so far, the markets haven't been reacting negatively to all this news about a recession. According to the textbook definition of a recession, which is 2 consecutive quarters of negative GDP growth, we are currently in a recession right now. Another indicator of a recession that people love to talk about is the inverted yield curve, which is when short-term debt instruments have higher yields than long-term instruments of the same credit risk. This also just recently happened, which has successfully predicted every single recession for the past half century. And yet so far, stocks have been continuing to climb upward despite all of this bad news. You might remember that just 2 months ago, I released a video titled High Yield Dividend Stocks I'm Buying During the Bear Market, in which I talked about what stocks I was buying during the dip. To give one example of just how much I was caught off guard by this dramatic rise in stock prices, I stated that I bought over $4,000 worth of Main Street Capital stock back on June 13th, and I was expecting the price to actually go even lower than that. Since that video was released, the share price of Main Street has since ballooned by over 26%, which left me wishing that I had bought even more shares back then. And since a lot of my favorite dividend stocks have already fully recovered or even at a positive for this year, I'm choosing not to buy any more shares of some of these for the time being. Some examples would include my favorite REIT, which is Realty Income, along with one of my other favorite REITs of all time, WP Carey, which is also up big compared to the rest of the market. A lot of my favorite business development companies, including Ares Capital and again Main Street Capital, have already rebounded big in the last month and a half. But despite a lot of my favorite stocks now being back up for the year, there are still good buying opportunities out there in my opinion. Many stocks are still trading at a discount below their book value and other metrics, as some stocks, particularly with BDCs that hold a lot of floating rate loans, still stand to earn more revenue in the quarters ahead due to rising interest rates. So in today's video, I wanted to go over a few stocks in my portfolio that are still down for the year in terms of share price that I'm still buying more aggressively than others. But as usual, be sure to perform your own research and come to your own conclusion before investing. So now let's go ahead and get started. The first stock we're going to take a look at today is STAG Industrial, ticker symbol STAG. STAG is a real estate investment trust that's focused on the acquisition and operation of single-tenant industrial properties throughout the United States. They tout being the only pure-play industrial REIT that's active across the entire domestic industrial real estate market. Founded in 2010, the company currently owns over 111 million square feet of industrial real estate across 559 different properties in 40 states as of June 30th of this year. With a market cap of over $5.8 billion, this makes them one of the largest owners and operators of U.S. industrial real estate. STAG is a stock that I've discussed a couple times on this channel before, but I was never really an aggressive buyer of it. Because typically when it comes to investing in dividend stocks, I usually don't invest in anything offering a yield of less than 4%. That's just my personal preference that I like to follow, which is more aggressive than the average dividend growth investor. But STAG Industrial's dividend yield has historically been hovering around 3 to 3.5%, which didn't really spark my interest. But now as of the making of this video, it currently yields 4.46%, which is the highest it's been in quite a long time for this company. If we expand the share price performance of STAG over the last 5 years, we can see continuous growth for this stock up until about December 31st of last year. Since then, the share price has fallen by almost a third, but it has more recently appeared it could be stabilizing. So what's caused this sizable sell-off since January of this year? I think the 2 biggest drivers of the sell-off were an announcement from Amazon and general recession fears. A few months ago, Amazon, which is STAG's largest tenant, announced that they were cutting back on their plans for expanding their e-commerce activity, and I think this scared a lot of investors. But Amazon only makes up 3.2% of their properties portfolio, so I'm really not convinced that this is going to be a big concern for STAG. The truth is that this is a company that's continued to perform well for years despite the falling share price in 2022. Adjusted funds from operation, which is a metric that I like to look at whenever I'm analyzing a REIT, continues to show year-over-year growth since 2012. They've also been able to continue to keep growing their real estate portfolio for pretty much every quarter for years, which is now up to 559 properties in 40 states. Not to mention their stock has continued to grow their monthly dividend amount every year for 10 years, although it has been pretty slow in terms of growth. A few other reasons why I like this stock is because a lot of their properties handle e-commerce activity. According to their latest investor presentation, roughly 40% of their properties handle this kind of activity. So that could be anything from logistics buildings to online order dispatch centers. Plus, STAG Industrial is also a triple net lease REIT, which means that the building tenants are responsible for paying taxes and maintenance on the buildings. This can obviously save REITs a lot of money that they can use to buy more properties or increase their dividends. Almost all of my favorite REITs out there are structured as triple net lease REITs. So to summarize, I personally think the falling share price of Stag hasn't been justified, and given all the good things we've been seeing, I'm still really optimistic about this stock. The next stock I keep buying is Store Capital, ticker symbol STOR. This is an internally managed net lease real estate investment trust that claims to be the leader in the acquisition, investment, and management of single-tenant operational real estate. Store Capital is one of the largest and fastest-growing net lease REITs and owns a large, well-diversified portfolio that consists of investments in more than 3,000 properties located across the United States. It's also the only REIT in Warren Buffett's portfolio, although he has recently been trimming down on the number of shares he owns. Store stock has a few similarities to Stag Industrials in terms of its performance. When first observing this company's share price, it definitely looks like things weren't going well for this company. The 5-year share price performance for STOR shows a steady decline that started all the way back in July of 2021. We can see it's lost about 33% of its share price compared to last July. So what's the possible explanation for this? I think it has to do a lot with what happened last year when the CEO of Store Capital was very quietly replaced, and the details as to why that happened haven't really been made public. Personally, I think this really damaged investors' confidence in this company, and I think this best explains the share price falling. But just like with Stag Industrial, there are a lot of good things to like about this company. It doesn't pay monthly dividends like Stag does, but it does offer a higher dividend yield of 5.48%. Plus, they've grown their dividend every year since their inception at a much faster rate than Stag. Right now, their stock pays a quarterly dividend of 39 cents per share, and it has a 5-year growth rate of 5.83% according to Seeking Alpha. Their financials also paint a really nice picture, as there's been year-over-year growth in adjusted funds from operation, rental revenue, and so on. This look into their portfolio shows how good their real estate has been performing. One thing in particular that helps Store out is their WALT, or their weighted average lease term, of 13.2 years. This is probably one of the best I've come across, and it's even better than WP Carey's, who I mentioned not too long ago had a great WALT of 11 years. The longer the WALT, the more stable and predictable the rental revenue will be because tenants are locked into longer-term leases. They also have an occupancy rating of 99.5%, which, given they have over 3,000 properties, is also one of the best I've ever seen for a REIT. If there is one criticism I have about Store Capital, it's that almost 7% of their portfolio is in restaurants. This is a sector that I typically like to avoid, along with movie theaters, gyms, and entertainment venues, because they fall under a lot more stress during recessions than other sectors. But the good news is Store Capital has slowly been moving away from investing in restaurants. You can see over the years they've been slowly making up a smaller and smaller portion of their portfolio. So overall, in my opinion, I think this stock is still at a good price, and everything I've looked at up to this point points to more prosperity in the future. Another stock that I'm still buying during the dip is Owl Rock Capital Corporation, ticker symbol ORCC. This is a business development company that makes investments in senior secured or unsecured loans, subordinated loans, and also considers equity-related securities, including warrants and preferred stocks. Owl Rock seeks to invest in growth, acquisitions, expansions, and refinancing. They invest in U.S. companies with an EBITDA between $10 million and $250 million annually, and/or revenue of $50 million and $2.5 billion. It's owned and managed by Blue Owl, which is a large specialty finance company that has over $94 billion worth of assets under management. This is a relatively new BDC, having just launched their stock back in 2019, but they already stand out for a couple of good reasons. Despite having their IPO just 3 years ago, they're currently the third largest business development company in the industry according to BDCinvestor.com, which, as I usually say with BDCs, size definitely matters. This is because this helps them out a lot in terms of their diversification in their holdings, which, speaking of which, Owl Rock's portfolio, in my opinion, is one of the strongest in the industry. It contains 88% senior secured debt and 99% being floating rate investments. Right now, their stock offers a very high dividend yield of 9.21%, and they pay dividends on a quarterly basis. Since their IPO, Owl Rock has paid a dividend of 31 cents per share. As of the making of this video, their stock is down about 5.54% for the year. Looking at their debt portfolio, we can see that it has some really good diversification across different industries. The software and healthcare sectors make up the majority of their portfolio, along with a very small amount geared towards leisure and entertainment businesses. As previously mentioned, 99% of their investments are in floating rate loans, which means that they should be able to earn more revenue from their debt thanks to interest rates going up. They have slowed down on making new investments, probably largely in part to all this market volatility and talks of a recession. But since my favorite BDC, which is Ares Capital, has already recovered so much already in the past few weeks, I've been focusing more on growing my Owl Rock position for the time being. Because everything that we've looked at up to this point, I think shows that Owl Rock is a pretty solid BDC for the investor looking for a high yield. And those are just a few of the stocks that I'm still currently buying and reinvesting my dividends into while the market has still been continuing to recover. But as I always like to remind people, be sure to perform your own research and due diligence before investing in anything. I don't suggest investing in any of these stocks for yourself unless you've looked into it and you've come to your own conclusion that these stocks are worth holding for you in your portfolio and that you're okay with the risks. It's always a good idea to know what exactly you're investing in and how the company is able to make money and pay its shareholders. And that's going to conclude today's video. Thank you all so much for watching. I really do appreciate it. If you found this video informative, please consider giving it a thumbs up below and also subscribe to the channel if you want to see more high yield dividend investing strategy videos. It would just let me know that there's enough people out there who want this kind of content, and I'll continue to provide you all with that content. All right, thanks again guys so much for watching, and until next time, take care.